Okay, hello everyone, and thanks to Structured Products Insights podcast. Today the topic is a quite relevant one, decrement indices. Some of you are aware, other ones are not. Decrement indices has been growing for close to 15 years, Eric, probably, and it's now becoming quite popular, especially in the French market and other European markets like Italy. Even in Canada, US, even in Asia, they're becoming popular. Let's say, in France, 22% of all outstanding volume is connected to a decrement index, which is important. And then in the last few months, there's been a lot of conversations about some of these indices underperforming and the potential impacts for investors and for the industry. So today, together with me and Andrew, my co-host, we have Eric Barthe, which again, massive expert on structured products and exotic derivatives. He's been in the industry for close to 20 years or more than 20 years, Eric?
Unfortunately, more than 20 years.
More than 20 years. Again, a lot of people know Eric, especially on his expertise on volatility, trading, and he did wrote a book on decrement indices. Eric asked me not to do any advertisement on the book, but I personally read it. I read it twice last night just to prepare for this podcast. So yeah, thank you, Eric. Thank you for being here.
You're welcome. Thank you for having me.
So, Eric, let's start. And I think we need to start, of course, by the history of the decrement indices, right? How did they start? Why did investment banks create them?
All right. So, yes, I mean, when we talk about decrement indices, indeed, we have to talk about, how traders ultimately hedge their books. So either you create a very vanilla product on a vanilla index with a vanilla payoff, and in that case, you can hedge with vanilla options, or you create an index that is not vanilla, and you have to make it hedgeable in some way, right? So imagine that I create an index on some stocks that I like, for instance, right? Well, predicting the dividends or hedging the dividend risk will be more difficult. That's one thing. So if I create such an index, but with a decrement, I will fix the dividends. I think we will talk about the mechanisms a bit later. Basically, this is the idea. I want to remove from my books as a trader the dividend risks that I cannot hedge or that are difficult to hedge. Just because maybe the index itself is difficult to hedge, or maybe because the product itself is difficult to hedge.
Okay.
So that was a bit, the point of view of the banks.
Yeah, but of course we also need to talk about, what happened in 2020, especially with SocGen, right? It's official. I mean, they used to be the big leaders on the auto-callable space, right? And then with COVID, they got hit very hard with hedging the dividend risk, right? And it seems, although decrement already existed until before COVID, it really picked up after 2020.
Yeah, clearly. 2020 was really a turning point for I would say for the structured product industry generally, but even more for those decrement indices indeed. So we remember 2020, right? There was the story of 2020. We may remember that was the COVID time, of course, right? So the companies in January 2020 announced the dividends based on the 2019 earnings. All was very well until COVID really came into Europe, that lockdowns were announced, and that governments announced also subsidies to companies. And then, hence, both regulators and governments insisted that companies that got subsidies may not pay dividends, right? So there was a shock in dividends, really an unprecedented shock to dividends. And the issue with the products, especially the French products, general, but I would say that affected the French banks in general, is those long-term autocallables on Euro stocks. So if you want, we have a double effect when the market went down, which happened in 2020. You remember you had a sharp drop in the equity market. So there are two effects. First, at a constant maturity, if you want, right? When the market goes down, the risk on dividends increases. So all the banks become longer dividends. But on top of that, as the market goes down, the expected maturity of those autocallables increase. Right? So you've got a double compounding effect. So really the dividend risk exploded because of the market dropping, and then all the dividends got smashed. Oh, it's a one-way street, right? So the banks, the French banks, at some point you have to cut your risk. You have to cut your risk because you exceed some position limits. So that's probably what happened. They had to cut probably at the low or close to the low, meaning dividend-wise, hence the losses that got crystallized.
Let's go back. I think we want to talk about the risk and volatility. And again, this podcast is listened not only by the structured products industry, but a lot of advisors in the US, Canada, across Europe. So let's focus. Why is this interest? Why are these decrement indices interested from the advisors and the investor perspective? Why do you think that they attracted to them?
Yeah, but as I tried to explain, having a decrement index means that you remove almost entirely the dividend risk for traders. So basically, you make the trader happy, right? And if you make the trader happy, you will get a higher coupon, right? This is basically the story. So make the trader happy, you get a better product. If it's easy to hedge, I will not, charge you for complex, risks that are going to sit in my book. Should I trade the product with you? So make me happy as a trader, I will get you higher coupon. Having a decrement index means that I fix the terms of the deal. So I don't have a dividend risk.
Yeah.
On top, of course, I can even do something better, which is I can choose a dividend level in the decrement that is higher than the real dividends in the market, right? So first I can remove the risk, so I'm happy. And on top of that, I can also have a higher dividend. I'm double happy if you want. So I can get you a bigger coupon. So that's a risk. I'm sure we'll talk about it, but also a benefit for the advisor in the sense that you've got a higher coupon or lower barrier.
Let's talk about it, right? This is the reality, right? And you've seen this, right? You can see that the coupons on this, especially on the callables on these decrement indices, are much higher compared with non-decrement. But what are the risks for the advisors, Eric?
So the risks are that you don't have an exposure to the real index, obviously, by construction. If you do an autocallable on Eurostocks, you look at the Eurostocks and this is your exposure. If you do something on Eurostocks 6% decrement or 5% decrement, this is the synthetic index that you have an exposure to. So this is a big difference, basically, right? You may not have the exposure to something you really know or can control. This extra risk is even bigger. Probably we are going to get there between the percentage decrements and the fixed points decrements, right? This is even maybe more difficult to comprehend, but basically the risk is that you don't have an exposure to the original equity index or equity stock.
So do you feel like the traders are hedging that risk effectively at the moment? Or do you feel there's still work to do in that kind of?
No, I believe, I think for the traders it works well. I mean, there are some, maybe we're going to talk about it a bit later, some explosive situations at the moment in the French market, because especially the fixed points decrements are quite toxic animals. I mean, they can be, I would say. Both for the investor and for the trader. The percentage decrement are much more smooth. So I would say that for the percentage decrement, I don't think there is any issue from the trading point of view. For the fixed point decrement, I'm not sure.
Let's talk about it, right? Because again, we've talked about this for years, right, Eric? And I remember doing the first research on decrement indices in France back in 2019, when I was still at the SRP, because we already had 5 years of data, so we could actually analyze. But again, that period between 2014 and 2019 was a bullish market, right? So overall, all these products performed extremely well, and again, was all just percentage. And of course, points are slightly different, right? Where instead of having a percentage that is subtracted every year, right, or every day, but the percentage shown usually analyzed, points are slightly different, and the points themselves, right, it means, because you reduce points, is that if you're in a bullish market, it will actually potentially benefit, right? This is some of the things, some of the sales points that people talk about, the point in decrements, right? But the problem is on the downside. when the underlying itself starts to go down. Well, what for you is let's say the leverage that people are putting on these point decrement indices?
Yeah, I mean the point decrements, they make sense also from a storytelling perspective.
Mhm.
At a micro level, if I tell you the story of a stock, right, of a company, I will say, and I think rightly so, that companies, they try to have a dividend policy that is stable and increasing. So, and in euros, they think in euros. It's true. If you look at the dividend history of most companies, you can see that the euro dividend is quite stable and increasing. Whatever the stock does, I would say, more or less, right? Even if the stock doubles, they may not double the dividend in absolute terms. So it makes sense to say, okay, a company, they think in absolute terms, so it makes sense to fix the decrement in points. But the big problem, obviously, is that when a company has a poorer performance, it cuts its dividends drastically. The fixed point decrement stock will obviously not cut the dividend by construction. It will keep paying out dividends as if the situation was much better. So this is a big issue, to the point that, it's something that I discuss often, that it can go negative. It can go to zero. Decrement stock, fixed point decrement stock can go to zero, and even negative. If it does so, there's a line in the index provider that the thing is delisted. So this is the end of the story.
Mm-hmm. So yeah,
sorry.
I do want to talk, right, because you already mentioned a couple of times, which is of course the market cap indices and the single stock decrement indices, right? And it's interesting enough because SPI published a white paper on decrement indices where we define that that broad market decrement indices, they do increase risk while they increase the return for the clients. There has not been many cases those products performing well, some bad, but in no extreme cases. But when we looked at the single stock decrement indices, which is just single stock, right? We have the Stellantis cases last year, and Eric, you're probably less involved, but I did share with you like the Bell story in Canada, where they also cut their dividend 2.5 weeks ago, and basically now you have close to 200 products, which some of them their indicative price is at 17% of initial. And again, we had another one, another company who published how the decrement indices had been performing extremely well in France, but in reality, it's because they're only looking at the ones that expired and matured. Because all the bad ones are still live, and now clients are stuck for the next few years.
Yeah. No, this is indeed the issue with the fixed decrements. So I think for indices, it's less toxic. I mean, first, maybe I should explain in 2 lines why the coupons are higher, right? In fixed decrement versus percentage decrement. So fixed decrement, as you explained, they pay out a fixed amount, whatever the underlying is doing. So if underlying is going, of course, in percentage, if you want, this fixed amount will be less with respect to the underlying price. On the contrary, if the underlying price is going down, this fixed amount, of course, will be bigger compared to the underlying price. But for autocallables, right, if the market goes up, you get autocalled. So you don't benefit from the outperformance on the upside. On the contrary, if the market goes down, you are stuck until maturity. And hence, the fixed point, looks better in terms of coupon than the percentage decrement, even with the same, initial amount, if you want. So that's the first thing. The first point. Secondly, decrements, they look good when the maturity is quite long. I mean, for a 1-year trade, a decrement will not.
Yeah, because the future is quite low, right? Because you need to discount all the dividends.
Exactly. So this is important. So when things go well, you get autocalled.
Mm-hmm.
I would say this is at the end, the dynamics of autocallable products anyway. But if things go badly in the terms of a fixed point decrement, you've got that effect that you explained with products quoting at 17%. First the spot goes down, but more importantly, the forward discounts the fact that this stock, this decrement, despite the very poor performance, is going to keep paying a very big fixed amount, right? So forward of the So first, the performance of the decrement is bad, but the forward is even worse.
Mm-hmm.
And of course, the price of a product depends on the forward, not on the spot. So that's the reason why those products can go to very low.
Yeah, correct. So, Andy, do you have a question?
Yeah. I mean, I think the big one for me is kind of like the almost the calibration of the decrement. How is that calculated between the percentage decrement and a fixed point decrement? What's the reasoning between the two of those, and how do they perform differently on a kind of day-to-day basis or a month-by-month basis? Something.
Well, how they are computed, I mean, there are index providers. There is, the terms are defined, I would say, by index providers. So you've got a formula, not necessarily super easy to read, but you've got a formula. All the terms are described. So, I mean, how do they perform? It depends also on the engine behind, right? A fixed decrement or even a percentage decrement on a highly performing stock or index will be great, because at the end, the engine of the performance, the initial engine of the performance, the underlier, right?
Yeah.
So if you've got an amazing stock, going to the roof, let's imagine you did some decrement on Nvidia, right? Overall, this stock is doing very well. You don't even feel it, right? You could have put a 20% decrement on Nvidia. I would think it would have performed very well. So this is the thing, right? Basically, you need to have a performing horse, right, behind that is extremely performing. When that doesn't happen anymore, then you've got cases like I think Bayer was the case some years ago. Now you've got Stellantis, the Canadian stock that Tiago mentions. It's difficult to establish a general rule. On top of that, the fixed decrement is path dependent. This is something very complicated also for the traders. Maybe we'll talk about it a bit later. And also, once again, the fact is that when a decrement works well, it auto-calls. So it disappears. And usually you replace it with a new auto-callable, with a new
Index
decrement, because if the stock went up, the former decrement is not big enough. So you may replace it by a larger decrement.
That's a very good point about the rollover, right, on the decrements. I never thought about it, but yeah, it's obvious, right, that will happen. So, Eric, let's talk more about the risk as well as hedging of the dividends, and because there is also a play there, right, which has impact on the final product and its performance itself. Can you give us a bit of 2-3 minutes explanation how hedging this dividend risk works, so people can understand, right? Because sometimes coupons change a lot, especially because it depends on the decrement, the point, the percentage, level, or the points level. Advisors are trying to understand, why do I get so different prices from even from the same trader.
You mean the difference in pricing between a normal index and the decrement
Correct.
index, right?
Yeah, correct. Yes.
Yeah. Okay. Yes. What is key is that there is no static way of hedging those products, those auto-callables, which means that as a trader, initially I will put a hedge in place, but according to the dynamics of the market, I will re-hedge, right? So typically in 2020, all the traders had to re-hedge the dividend risk once the market went down, right? And after the market went down, the dividends were very, very, very low. They had to sell at a very, very low price. So you have to, when you are a trader, you have to build a model that tells you, in our case at least, how the dividends will move when the market itself moves. This is not easy. And sometimes things do not happen, of course, according to the model. 2020 was, of course, an example of that. The dividends actually moved much more than proportionally. And usually, I would say the common way of modeling dividends is the following. You say, okay, I believe that the front-end dividends, the ones that are going to be paid this year or next year, right, are quite sticky, in the sense that they depend on a situation that I know. Because I know the economy, I know the results of the company last year, etc. On the contrary, so this is very sticky, right? That should not change much. 2020 being the big exception, because even the front end got absolutely smashed. But for the 10-year dividends, well, I don't know. I cannot predict that. That will depend more or less with the economy and the market. So actually, I predict the long term to be more or less proportional to the equity market. So this is typically how you model. But of course, things sometimes do not behave according to models, hence the 2020.
Yeah.
So this is the real index. If I price an autocallable on the real Euro stocks, I have to take those things into account in my pricing, right? Basically, as a trader, I need to say, okay, what am I going to do and at what price I'm going to be able to hedge if this scenario happens or this scenario happens. So I need a model that correlates, if you want, the way the dividend move with equity. On the contrary, if I price something on a decrement index, well, by definition, I know how the dividends will behave because I fix them. So I get rid of this model problem for the dividend part. That's why I'm more comfortable and I don't have this uncertainty, so I'm happier. So I pay a higher coupon.
I mean, it sounds like the stability it brings to the decrement index is massive. Surely the dividend risk is then kind of shifted onto the investor side as opposed to the issuer side.
Yes, it's a way of saying it. It's a way of saying it. Basically, if the investor doesn't really understand that his risk is not on the original index, but on the decrement index, implicitly is taking the dividend risk without realizing it.
Which ultimately, that's the reason why they have a higher coupon, because they are adding more tail risk, right? More control risk to potentially bad scenarios. So, Eric, look, we talked about it, but I want to try to get a summary for advisors, right, and for the industry. For you, right? For me, decrement is a feature, right? You put it in, you put it out. It's not a bad thing. It's just a formula, and you just need to know how it works. So, but of course, there are all people who abuse of the formulas and try to. So, for advisors out there, what do you think it's a fair decrement? How it would look, and what are, let's say, the things that they need to look at it to be able to say, okay, this is a good investment for my clients.
That's difficult, right? Because ultimately it depends on the trajectory of the stock. Once again, 20% decrement on Tesla, or sorry, on Nvidia.
You'll probably get 80% annualized coupon on that.
Yeah, I don't know, but probably those kind of things, right? So the idea, I think, first is to start by saying, okay, you should not, we mentioned Stellantis, right, which is not doing very well as a stock, to put it diplomatically, currently at least. If advisors invest in structured products the way they invest in stocks, meaning they have, plenty of autocallables on single stock decrements, the damage is only on one of the many, right? And not on everything, because they put everything in one. I mean, this is obvious, but it's worth saying. That's one thing. The fixed point decrement, I mean, it's a risk. I mean, you have to understand that you basically bet on the fact that nothing bad will happen to the company, that there will not be a change of policy. So I would say fixed point decrement on stocks are a toxic thing. So they need to be understood. That's it. Because especially if you go for a 5-year or 7-year product, I mean, you have to be careful to be able to assess what will be the shape of the company in 7 years. It's tough, I believe. When it's about percentage decrement, this is different to me, because it will pay a higher coupon too, but at least you don't have this horrible secondary market behavior, right? Implicitly, if you want, the percentage decrement is like a company that cuts its dividend proportionally to its stock price. That makes more sense. So I would say take a decrement that is more or less close to historical levels. I'm not sure 6-7% decrement is very reasonable. I mean, there are some indices with that. Yeah, get as close as possible to the real deal, if I may say.
And you work a lot on disclosure. What are the things you see on this disclosure on decrement indices? So, because Eric, you talked about single stock point decrement. It's a topic, but I also know by a fact that actually it's not most manufacturers. There is a demand from brokers asking for this for these products. It's not more a push from the manufacturers, but more a demand that they've been asked to price these. And what type of disclosures do you see out there? What do you think it's something that the minimum that needs to be shown?
Yeah, I think it's interesting. Obviously, it's something that isn't particularly standardized across issuers at the moment. I think it's hard to say the exact kind of minimum that would need to be disclosed for for a document displaying this. You have some issuers I can see that had, nearly half a page, a full page worth of information about this just to try and give themselves some information about it. But I think it's very difficult to say what the minimum is. I think that the lack of standardization across the industry with this, it does make it difficult to define what needs to be displayed and disclosed on a document.
So Eric, again, where do you think this decrement index is heading for, end of 2025, 2026?
It's a tough question. No, at first, I think this concept of decrement is very much the way traders or banks want to go to, right? I'm not talking about the fixed point, because the fixed point, I think I was clear enough that it's a bit toxic, also for the banks. But the decrement in percentage, it makes sense. For the bank, we have a lot of those vol target or vol, things also. This is the same thing. Basically, as a trader, you want to hedge something that is a Black-Scholes potato, meaning that you can predict the vol and you can predict the dividend. This is heaven for a trader. There is more and more of this, right? And I think, Tiago, you know some very big successes in the US with those indices that are totally synthetic, right? In the sense that they leverage according to the volatility an existing
completely.
Index.
A lot of them. Completely. A lot of them. 35, 38% volatility, right? It's constant, gap and down, but it gives the actually a good coupon and a reliable coupon, because vol is always there, so you kind of know that that's then the coupon is always just depending on the interest rates. That's the only thing that
exactly, and it achieves at the end. There was this some years ago, there was this story of cost P3, right? I mean, if we want to do the history of social products, cost P3, it was 1.5 the cost P2, right? It was a French joke, I guess. And it was supposed to move every day, so 1.5 times the move of the cost P. Why? The idea was, of course, if I create cost P3 is going to be more volatile than cost P2, obviously, right? But so that was already the idea, right? I think it was in 2017.
2017, 2018. Yeah, it blew up in 2018.
Exactly, and it blew up because there was it's not because you multiply the return by 1.5 that you can control the volatility. Still, the volatility can be totally depressed. This is what happened, right? The cost P went down, but volatility was totally depressed. So the cost P 1.5 was not, 3 was not moving as much as expected. So what I want to say is that yes, by having this vol advantage, you control exactly the path. So, or vol target, sorry. So I'm not sure it's this is the way the industry is going, and I don't think it's specifically bad. Just this is synthetic exposure. So probably that would be interesting to see in a portfolio context. I mean, I know this is a word and the expression that is overused, but it's true. I would say, why not actually? Why not to look at those things? At the end, it's an S&P or a Nasdaq, levered, right? On which you sell a put. At the end, this is what you do.
And again, dividend
makes sense.
The dividend is a risk on your portfolio, right? And this could be a way to hedge that. Okay, interesting. So, Andrew, what about on an investor education angle? What do you say is the things that structured products industry need to do to make sure that investors understand this type of product?
Yeah, I think obviously we have an idea of how we've had enough data now to understand how these products are working in down markets and sideways markets. But I think there isn't enough education out to a lot of investors about how this can affect them if the market is to drop. The volatility is high at the moment. It has been high for a while. I think the education on that kind of front is a little bit lacking. And if that picks up, then people will be much more likely to want to pick these up on the retail market.
Right. So, Eric, last message for the industry and for the advisors. If you had to sum up decrement indices and being used on structured products, what will be your 2 cents?
First, there's nothing bad, nothing good about them, right? And I like financial engineering. So I think there are beauties. There are beauties of financial engineering. This is my first point. But it's important that you know the risk you take, especially when you sell a put, right? For me, there is a fundamental difference between selling a put on something you don't understand or buying a call on something you don't understand. Here, with with autocallables, you sell a put. So as an investor, you risk potentially your full notional. So as long as the investor understands, it's good.
Mm-hmm.
There's no problem. But fixed point decrements, I think are difficult animals to understand. Even for professionals, even for traders, they are difficult. They are totally path dependent once again.
Mm-hmm.
Meaning that, you can have the market to start at 100, to go back to 100, but depending on if it went up first and down or down first and up,
Yeah.
so the fixed point decrement will not end up at the same level. This is a key feature of the fixed point decrement. That makes the life of traders horrible, and that makes also the life of investors horrible. Personally, first, I cannot tell you where the market will be in 10 years. This is my first problem, right?
Mm-hmm.
But even if I could, right, I couldn't tell you the path. I think very, very few people can tell you the path of the market. Okay, the market will be, 20% higher in 10 years, maybe, I have no clue, right? But nobody will tell you the path.
Unless you do the opposite of Jim Cramer.
Maybe that's a
Okay, great. Look, thank you, Eric, for this pretty good conversation with me and Andrew. I think we're both happy that you're able to join us. And yeah, I hope everyone thought this interesting, educational, and yeah, once again, thank you, Eric. And yeah, have a nice day.
Okay, thank you very much,
Really
Tiago.
appreciate it. Thank you.
Bye-bye.
Okay, here you go. I stopped the recording.